Corporate insiders are selling stock at a ratio of 4.7 to 1. For every dollar insiders buy, they're selling for $70. That's the highest selling ratio since early 2021, right before the market crashed 25%. Before that, similar levels in late 2007, right before the financial crisis. Before that, early 2000, right before the dot-com crash. This isn't coincidence, this is pattern. When people who run companies, who see the financials, who know the business, sell at ratios above 4 to 1, crashes follow. Within 3 to 12 months, markets fall 20-40%. Right now, we're at 4.7 to 1, the highest level in 3 years. Let me show you what insider selling is, why it predicts crashes, what 4.7 to 1 means historically, and why you need to position now. Corporate insiders are executives, directors, and 10% shareholders, CEOs, CFOs, board members. People with legal access to material non-public information. They know revenue before earnings reports. They know if contracts are signed or cancelled. They know if growth accelerates or decelerates. When insiders buy or sell, they report to SEC within 2 days. Form 4 filings, public record. That data creates the insider selling ratio. Total dollar value of sales divided by purchases. If insiders sell 100 million and buy 20 million, ratio is 5 to 1. The ratio matters because insiders only buy for one reason. They think stock will rise. When a CEO buys 1 million of their company's stock, they're betting personal capital that business will perform well. No other motive. But insiders sell for many reasons. Tax planning, estate planning, diversification, liquidity needs. A CEO might sell stock to buy a house or pay taxes, not because they think stock will fall. Individual insider sales can be noisy with multiple motivations. But when you aggregate all insider activity across all companies nationwide, when you look at the ratio of total selling to total buying systematically, the noise cancels out completely. What remains is pure signal. And that signal is abundantly clear today. When insiders sell at ratios above 4 to 1, they're not just diversifying or paying taxes routinely. They're exiting en masse. They're collectively reducing exposure to equities. And they're doing it because they see something in the economic data, in their company's performance, in customer behavior, that tells them valuations are too high and risk is too elevated. Now let me show you the historical pattern because the 4 to 1 threshold has been remarkably consistent. In early 2000, the insider selling ratio spiked above 5 to 1. Insiders at tech companies, at telecom companies, at dot-com startups were selling aggressively. The public was buying. Retail investors were pouring money into anything with a .com in the name. But insiders knew the revenue wasn't there, the business models didn't work, the valuations were insane, so they sold. March 2000, the Nasdaq peaked. April 2000, it started falling. By October 2002, the Nasdaq was down 78% from its peak. Companies went bankrupt, trillions in wealth evaporated. And the insiders who sold at 5 to 1 ratios in early 2000 avoided the entire crash. They exited at the top, while retail investors bought all the way down. In late 2007, the insider selling ratio hit 4.5 to 1. Insiders at banks, at home builders, at mortgage companies were selling heavily. The public didn't see the crisis coming. Housing prices were still rising, credit was still flowing. But insiders saw the loan books. They saw the subprime mortgages. They saw the derivatives exposure. They knew the system was fragile, so they sold. October 2007, the S&P 500 peaked. By March 2009, it was down 57%. The financial system nearly collapsed. Banks failed. The economy entered the worst recession since the Great Depression. And the insiders who sold at 4.5 to 1 in late 2007 avoided catastrophic losses. They were out before the crash. In early 2021, the insider selling ratio reached 4.8 to 1. Insiders at tech companies, at SPACs, at companies that went public during the pandemic boom were selling at record levels. Valuations were extreme. Growth stocks traded at 50 to 100 times sales. Unprofitable companies had billion-dollar market caps. But insiders knew growth was decelerating. They knew profitability wasn't coming. They knew the Fed would eventually tighten, so they sold. January 2022, markets peaked. By October 2022, the Nasdaq was down 38%. Growth stocks fell 60-80%. Unprofitable tech companies crashed 90%. And the insiders who sold at 4.8 to 1 in early 2021 avoided the entire drawdown. They exited at peak valuations before reality set in. 3 crashes. 3 times the insider selling ratio exceeded 4 to 1 beforehand. And now, in early 2026, the ratio is 4.7 to 1 again. The pattern is repeating. The insiders are selling. And history says what comes next. Now let me show you who's selling, because the names matter. This isn't random mid-level executives liquidating options. This is founders, CEOs, billionaires who built these companies. People who historically never sold, until now. Warren Buffett selling Apple. His largest holding, 50% of Berkshire's portfolio reduced to 30%. 300 million shares sold. That's insider selling. Buffett has access to Apple's data. He knows iPhone sales trends. He knows services revenue. He knows what's coming. And he's reducing exposure. Jeff Bezos selling Amazon. $8.5 billion in 9 days, the fastest liquidation in his history. Bezos built Amazon. He knows e-commerce trends. He knows AWS growth. He knows the business better than anyone. And he sold $8.5 billion. That's not tax planning, that's exit velocity. Bill Gates reducing Microsoft 55%, from 28% of portfolio to 13%. Gates knows Microsoft's AI spending. He knows Azure's competitive position. He knows the CapEx explosion isn't generating proportional returns. And he's selling. Jamie Dimon selling JP Morgan for the first time in 19 years. The CEO of the largest bank in America, the person who sees the entire financial system, selling his own bank's stock after holding for nearly 2 decades. That's an insider telling you something is wrong. Mark Zuckerberg selling Meta. $638 million in February 2024 alone. Continuous selling every month. The founder and CEO liquidating while the stock is near all-time highs. He's not diversifying, he's exiting. These 5 alone represent over $10 billion in insider sales, and they're not the only ones. Across corporate America, insiders are selling, tech executives, bank CEOs, retail company founders, manufacturing company directors. Everyone with inside information is reducing exposure. The ratio is 4.7 to 1 because the selling is broad and aggressive, while the buying is minimal and defensive. Now let me show you why insiders are selling, because understanding the motive helps you see what's coming. Insiders sell when they believe current valuations don't reflect future fundamentals, when stock prices are high but business performance is weakening, when markets are optimistic but reality is deteriorating. Right now, insiders see revenue growth decelerating across industries. They see customers cutting spending. They see inventory building. They see pricing power eroding. They see all the early signs of economic slowdown that don't show up in headline numbers yet. But they know these trends will eventually hit earnings. And when earnings disappoint, stock prices fall. So they sell before the disappointment arrives. Insiders also see valuation extremes. The S&P 500 trading at 22 times forward earnings. The Magnificent 7 trading at 30, 50 times earnings. Valuations that only make sense if growth accelerates and margins expand. But insiders know growth is decelerating and margins are compressing. They know the valuations are unsustainable. So they sell at peak prices before reality reprices the market. Insiders see the macro risks that retail investors ignore. They see the SARM rule at 0.35, approaching recession trigger. They see the inverted yield curve. They see commercial real estate imploding. They see consumer credit stress. They see all the indicators that historically precede recessions. And they know recessions destroy stock prices, so they sell before the recession hits. This is why the insider selling ratio works as a crash predictor. It's not magical, it's not mystical, it's information advantage. Insiders know more than you do. They see the business from inside. And when they collectively sell at 4.7 to 1 ratios, they're telling you they see risk that the market hasn't priced in yet. Now let me show you what happens after the ratio exceeds 4 to 1. Because the timeline is consistent, the ratio hits 4 plus to 1. Markets continue rising for 3 to 6 months because retail investors and institutions are still buying. The insiders are selling into this buying pressure. They're exiting at high prices while demand still exists. Then something breaks. Earnings disappoint. Economic data weakens. The Fed makes a mistake. Geopolitical crisis emerges. The catalyst varies. But the outcome is the same. Markets turn. And once they turn, the decline is swift and severe. In 2000, markets fell 78% over 30 months. In 2008, markets fell 57% over 18 months. In 2022, markets fell 38% over 10 months. The magnitude varies, the duration varies, but the pattern is consistent. High insider selling ratios precede significant market declines. And the higher the ratio, the worse the crash. At 4.7 to 1, we're at the high end of historical warning levels. This isn't a mild correction signal. This is a major crash warning, the kind that precedes 30-50% declines, the kind where portfolios get destroyed, the kind where retirement accounts lose a decade of gains. And the insiders are already out. Now let me show you the current buying side because it's equally revealing. When insiders are buying, the ratio drops. When insiders collectively see value and opportunity, they buy aggressively. The ratio falls below 2 to 1, sometimes below 1 to 1. That's what happened in March 2020 during COVID crash. Insiders bought heavily, the ratio inverted, and markets bottomed immediately. That's what happened in March 2009 after the financial crisis. Insiders saw valuations at generational lows. They bought. The ratio dropped to 1.5 to 1. And markets began the longest bull run in history. But right now, insiders aren't buying. The ratio is 4.7 to 1 because buying is minimal. Corporate executives aren't putting personal capital into their own company's stock. That tells you they don't see value. They don't see opportunity. They see risk. And they're selling, not buying. This is the most damning signal. If insiders thought stocks were cheap, they'd buy. If they thought their companies were undervalued, they'd accumulate shares. But they're not. They're selling at the highest ratios in 3 years. That's unanimous bearishness from the people who know the most. Now let me show you what you should do, because understanding the signal is useless without action. First, recognize that 4.7 to 1 is a major warning. This isn't minor profit taking. This is aggressive risk reduction by people with information advantage. Treat it seriously. Second, reduce equity exposure immediately, not to zero, but to levels where a 30-40% decline doesn't destroy your financial plan. If you're 100% stocks, move to 60-70% stocks, 30-40% cash. The insiders are selling, you should too. Third, avoid the stocks with the highest insider selling. Companies where CEOs and directors are selling aggressively are companies with the worst internal outlook. If insiders are exiting, you should too. Focus on companies with insider buying or low insider selling. Fourth, increase cash holdings and wait. When the market crashes, when stocks fall 30-40%, when the insider selling ratio drops below 2 to 1 because insiders start buying, that's when you redeploy. But right now, at 4.7 to 1, the signal's clear, get defensive. Fifth, don't fight the insider signal. Retail investors always think they're smarter than insiders. They think insiders are wrong. They think this time is different. But the insiders have better information. They know the business, they see the financials, they're not wrong, and fighting them is expensive. The insider selling ratio is 4.7 to 1. That's the highest level since early 2021, right before a 38% crash. Before that, similar levels in 2007, right before a 57% crash. Before that in 2000, right before a 78% crash. The pattern is consistent, the signal is clear, the insiders are selling and crashes follow. Warren Buffett selling Apple, Jeff Bezos selling Amazon, Bill Gates selling Microsoft, Jamie Dimon selling JP Morgan, Mark Zuckerberg selling Meta. These aren't random diversification trades. This is coordinated exit by people who know what's coming. They see the revenue deceleration, they see the valuation extremes, they see the macro risks, and they're getting out. The ratio doesn't lie. When it exceeds 4 to 1, markets crash within 3 to 12 months. We're at 4.7 to 1 right now. The timeline is compressed, the warning is urgent, and the billionaires are already positioned. The only question is whether you'll sell with the insiders at 4.7 to 1, or whether you'll hold through the crash that history says is coming. Corporate insiders only buy for one reason. They think the stock will go up. Right now, they're not buying, they're selling. At 4.7 to 1 ratios that have preceded every major crash in the past 25 years. The signal has been delivered. The math is clear, the pattern is undeniable. The question is whether you're listening.